stock in the Dow is trading in record territory, but yet does that suggest that a lack of breadth is hitting this rally? And forget the Dow, let's look at all of the stocks that are out there and how they're reacting with the traders at the New York Stock Exchange, CME Group and the NYMEX, plus Jon Hilsenrath. Teddy, you got anything for Jon? Any question? Because I know traders love to have this opportunity to talk to the guy whose reporting tends to move the markets.
Well, I mean, as far as I'm concerned, and I think he would agree, though he didn't quite say it, that the Fed continues to be the 800-pound gorilla in the room. I think that they do an exceptionally good job at dealing with investor expectations. And I would also agree with his analysis and what he says, that the way I see it, the Fed's sort of between a rock and a hard place, and they don't have a lot of wiggle room at this point, because I don't know how you come off of zero interest rates, which has clearly been a motivating factor for the equity markets for the last couple of years. They seriously really start to shift gears. It's going to be real interesting to see what impact it has on the market. I think it's going to be negative, but not everybody agrees with that.
Jon?
Well, I agree with pretty much everything that he says. The Fed has a very tough challenge on its hand. And, it can expect some volatility, but frankly, I think the Fed would like to see some volatility. There's a fear at the Fed that the market's gotten complacent with interest rates staying this low. And it's why, I said earlier, and I'll repeat it now, that, I think those words considerable time stay in their statement, but I think they're qualified. We have to look at what Janet Yellen has been saying since June, which is that if the economy continues to improve more quickly than expected, the Fed will raise rates sooner than expected. Yeah. I think that's the important qualification that I'm going to be looking at.
And I'm looking at inflation, too. And Jeff Grossman, you'd be a perfect person to weigh in on this down at the NYMEX. You do see oil moving higher for a panoply of reasons, but we've got the grains lower. We've got a lot of commodities that have dropped pretty precipitously. On balance, we do have energy so much lower. Inflation's just not there, Jeff.
Well, that's been the case for the last 6 months. That's been just taken out of the equation. Today, though, was an interesting day. Along with that stock market rally, the crude oil and products had a monster rally today. In fact, I would like to consider that. Remember, we were trading almost $4, $4.50 lower yesterday, as a matter of fact, on the lows. This is quite a bit of a turnaround. What we do have in play, of course, is we do have an option expiration in crude oil coming at the end of this week, and that's going to be a play here, and that's why I think the $95 number is going to be a factor for the rest of the next 2 sessions or so. What you do have, though, is a market that, unfortunately, it got to the point where everybody got a little too comfortable selling it. And times like this, there's a technical rally like this that hits everyone square between the eyes. And
how do you know? A little too comfortable selling it. I mean, for us laymen here, we're thinking, my goodness, it's going down. We have a lot of supply. And then you could weigh in, Trent, certainly on what's going on with the 10-year Treasury with the yield at 2.58%. That's a statement, isn't it? Especially considering we've been at 2.61 just a couple of days ago.
Well, it is, and I think that. But sorry, I didn't want to interrupt Jon.
No, go ahead.
No, as far as the 10 rate's concerned, Liz, I think that the risk coming into the day was certainly that the rates move lower, like we had seen just a couple months ago. Look, I mean, this notion that the Fed was going to change the verbiage really gained some steam late last week, and until Jon's column earlier today, I think that still was the case for a lot of people. I think a lot of people were expecting the communication tomorrow to be more hawkish. That got overdone as far as what was priced into the market coming into today. So before Jon's column, I mean, right now it's a different game since we've seen the markets move since the column came out. But the risk was certainly to the upside in the equity markets and to the downside with rates, because if they would have delivered on a more hawkish tone, like I said, I think a lot of that was already priced in. If the Fed failed to deliver on those sentiments, I think we would have seen a big pop in equity markets similar to what we had today, and we'd see rates move back down. So I think Jon essentially could have saved some people some pain tomorrow if they were over-positioned expecting a hawkish tone, because had they gotten it, I'm not sure they would have gotten a lot of more near-term price action anyway.
Look at that, Jon.
I'm certainly not trying to cause or save anybody pain, but I mean, what I do want to say is, you know, the market tends to look at these issues in very binary words. Considerable time is either in the statement or it's not in the statement. You know, as I've been saying, I think that they're going to qualify that language in ways that Janet Yellen has been qualifying it for a couple of months now. You know, by saying, listen, if the economy keeps exceeding our expectations, we're going to move earlier. You know, that's a point that Yellen has been trying to get across to people. She did it again in Jackson Hole. And then, you know, we're also talking about this bond buying program. You know, they're moving towards ending that. And they're also about to announce the kind of mechanics of their exit strategy. Those are all hawkish steps. They're not all dovish steps. So I think, you know, we should be careful about looking at a statement tomorrow and say, oh, if considerable time is in there, they're dovish, think nothing has changed. They are going through a process right now which is leading toward interest rate increases.
Okay. John
and you know,
team.
the question is whether they take a big step or a small step. And I just think, you know, Janet Yellen's a very methodical person. I think she moves in a measured pace.
She would have to be, because nobody wants to gyrate these markets, although we got a little precursor here. Jon Hilsenrath, in his first television interview since the webcast this morning, the shot heard around the U.S. stock market. Certainly great to see you, and thanks to our traders. So wonderful to have you weigh in on this discussion that we hope for our viewers really gives you a window into why we saw such a significant turnaround and a big swing in the markets from every single index. The closing bell, we've still got time. This thing could change, so you have to stay with us. We're 44 minutes away. Clear the decks, or at least